Welcome back, traders and investors, to Benzinga's pre-market prep, brought to you by MarketFi. I'm your co-host, Joel Alconin, along with Brianna Valesky, and we have Glenn Martin on the line. He's Chief Executive of ShareMaestro Limited. Glenn, how you doing today?
I'm doing fine, thanks very much.
You have a UK investment software firm. Could you tell us a little bit about that?
Well, ShareMaestro is an investment software which values both the FTSE 100 and all shares in the FTSE All Share Index. I set it up in 2007 after I'd developed my own share valuation system, which proved to be more right than wrong. And I launched it in 2007, and it's done very well. And on the back of ShareMaestro, I was asked to write a book called How to Value Shares and Outperform the Market. And since then, I've just written a book called 7 Successful Stock Market Strategies, which is aimed at principally at the private investor, to persuade him that actually stock market investing is a lot easier than they may think it is, and also that it produces far greater returns than investing in cash. I think the US private investor is a bit more sophisticated than the British one, because they're used to investing in the stock market, but over in Britain that's not the norm.
No. All right. Moving on. Could you tell us just some of the basic tenets of your book and or of your investment strategy?
Yeah, there are 2 systems that underpin the strategies. One is the market valuation system, which tells you whether the market is expensive or cheap in percentage terms. And the book has a spreadsheet which you can build, or you can get the same information automatically produced by ShareMaestro. And there's a strategy in the book that if the valuation of the FTSE 100 is above 105%, you buy, and when it falls down to 95% or below, you sell. And that strategy has produced a profit for every buy-sell pair since the beginning of the FTSE 100 in 1984. That strategy can also be used as buy-sell signals for the FTSE 250, which is the next 250 smaller shares after the FTSE 100. And the FTSE 250 has had an even better performance than the FTSE 100. So that strategy is proven over a long term to work. The other strategy within the book the other system within the book is what I call a market momentum system. So there are times when the market goes into free fall because it's gripped by panic. And the credit crunch would be an example, irrespective of valuations. And that system uses moving averages. So essentially, when the 100-day moving average falls below the 200-day moving average, and then the price falls a further 10%, you exit the market, and you go back into the market when the price of the 100-day moving average moves above the 200-day moving average. And that system would have saved you 100 points actually 1,000 points of the credit crunch crash. So when you combine those 2 systems, you get very powerful returns. So there are a number of strategies for the investor to follow in the book, the simplest being to buy and hold either the FTSE 100 or the FTSE 250. Those have produced annual returns of over 9% and over 11% over a long term. But with that strategy, you need to get a valuation first, which I was talking about, because if you'd purchased at the top of the market at the end of the dot-com boom in 1999, at the end of 99, it would have taken you 7 years to recoup your money, even with reinvested dividends. Whereas if you'd got a valuation before doing that, it would have shown that the market was only worth 56% of the market price. So those are the 2 simplest strategies. The next strategies use the market timing systems I've just talked about, and that they give you annual returns, or have done over the last 30 years, of 11% and 10% respectively.
Timing. Timing is everything. What's your system telling you now?
System's telling me now that for the FTSE 100, it's valuing it about 105%. It's been a lot more than that. So we're now getting to the stage where the market is looking to be fairly valued, and if it rises much more, it would then be priced above its value. So you'd be then thinking to exit the market. We haven't got there yet. There is a spread trading strategy in the book where the exit, because of the risks in spread trading, the exit signal is 105% rather than 95%. But that spread trading strategy has produced fantastic returns over the last 30 years of nearly 37% on the most extreme example, which is, as far as I know, better than any hedge fund has produced. But it is very risky in the short term. All the strategies in my book are for investors, not traders. So unlike your previous speaker, I have no idea what the market's going to do tomorrow or in the next few weeks, but this is for investment of 5 years upwards. So the market at the moment in the UK is pretty fairly valued. From what I hear in the States, comparatively, I would have said it was probably overvalued, but we'll see. But I'm not an expert on the States. I just look at the price-earning ratios and so on, which are higher than in the UK.
Okay, so you haven't tried to apply this to the U.S. stock market then?
No, I haven't. I've been asked to many times, but I'd need to do a lot of research, the same sort of research that I put into the FTSE 100 system to do that, and I haven't yet done that.
Okay, and you talked about there were 7 strategies in there. You mentioned a couple of them. Is there one or two others that you could touch on before we end the interview?
Well, there's the spread trading strategy. What I would say is, if anybody wants to understand that in more detail before, if they're thinking of getting the book, you can get that strategy from the ShareMaestro website at sharemaestro.co.uk. That also has a simulator on it, so you can see what return you would have got over the last 10 and 30 years according to your appetite for risk. It shows every single trade. The final strategy in the book is actually not a strategy with a return, but it's a tax efficient strategy to create through spread trading, but with no risk, a synthetic tracker fund, because the book is all about using tracker funds, so the individual investor doesn't have to just do stock picking or anything like that. And tracker funds are hugely successful in the UK and probably in the US. But the benefit of a tracker fund is a synthetic tracker fund using spread trades under UK tax law. There is no capital gains tax on spread trading profits, nor is there effectively any higher rate tax on dividends. So it's a very tax efficient way of creating a tracker fund if you are in the tax paying community, as it were. And so that's the final strategy.
Okay, we've been on the line with Glenn Martin. He's Chief Executive of ShareMaestro Limited. He's written a couple books here. The most recent book is 7 Successful Stock Market Strategies. So if you're looking at the FTSE Index, you want to invest across the pond, I encourage you to take a look at Glenn's work. Glenn, thanks a lot for coming on. Have a great day. We hope to speak to you again soon.
That's a pleasure. Many thanks.
Thanks to you.